Beyond the human tragedy unfolding in Israel, we acknowledge the risk of escalation in the region and what it could mean for oil prices. Escalation, in particular involving Iran, could disrupt oil supplies in an already tight global market. We see this more as a risk case than a base case for a tactical escalation. But if the war significantly cuts off oil supply, we worry that the potential price shock could degrade an already fragile global economy and prolong equity market volatility. Let's take a closer look. The global oil supply has become very tight. Oil companies have cut capital investment and exploration over the past 10 years, and the US has drawn down the strategic petroleum reserve from 650 to 350 million barrels in just over 3 years. Nearly all excess oil production capacity sits in Saudi Arabia, United Arab Emirates, Iraq, and Kuwait. While there's potential for incrementally more production from countries such as Guyana and Brazil, at the moment, oil producers outside the Middle East are tapped out. Further, Qatar is among big three exporters of natural gas globally, potentially further straining an important source of energy if the war escalates. About 20% of the world's oil and liquefied natural gas flows through the Strait of Hormuz along the coast of Iran, making it a potential chokehold for oil if the strait is blocked because of war. However, we see few signs of concerns in the market over how much disruption the war could cause. Oil prices surge only briefly after the attack by Hamas. Instead, all eyes have been on rising long-term yields, with the 10-year Treasury yield hitting 5% this month. Rising interest rates and tighter financial conditions in the US, Europe, and China have added to investor concern that the global economic outlook is deteriorating. As a result, the equity market decline that started 2 months ago has picked up speed, with global equities falling roughly 10% from their highs. We think there's little cushion for the global economy or equities to withstand an energy supply shock. In our global policy model that guides tactical asset allocation in our multi-asset portfolios, we felt an overweight position to natural resources because of the lack of investment in new production and attractive valuations. The risks related to the war further support this positioning. With equities, we are underweight globally based on our outlook of a slowdown in the global economy, which an oil shock could accelerate.